In the global precious metal system, the most important numbers are not headlines. They are inventories, settlement venues, and the cost of funding. One data series captures all three at once. London Vault holdings reported by the LBMA. In March 2021, LBMA data showed a record stock of silver in London vaults at 38,859 tons. By February 2025, LBMA reported silver in London had fallen to 22,462 tons, the lowest level in that dataset going back to mid-2016. That is a decline of 16,397 tons from the March 2021 peak, a drop of roughly 42%. Over the same window, the U.S. government's debt trajectory moved in the opposite direction. By early January 2026, U.S. gross national debt was reported at $38.43 trillion, with debt held by the public at $30.81 trillion. In fiscal year 2025, U.S. interest payments were reported at $970 billion. These are separate data sets produced for different purposes, but they describe a single environment: larger sovereign balance sheets, heavier interest burdens, and tighter competition for collateral and funding across the financial system. The question is not whether London or New York wins. The question is what the flows reveal about how the modern bullion market functions when record inflows into one venue coincide with structural outflows from another, and when the world's largest sovereign borrower is financing itself at scale in the same period. To understand why LBMA vault holdings matter, it helps to define what the LBMA numbers actually represent. The LBMA's London Vault data reports the volume of loco London gold and silver held in London vaults offering custodian services, including the commercial vaults, and for gold, the Bank of England's holdings. The LBMA notes the figures represent holdings within the M25 area, include all physical forms of metal, and are published monthly with a 1-month lag. This data is not a full census of all bullion in the United Kingdom, and it is not a global inventory count. It is a practical measure of the metal available inside the London clearing ecosystem that underpins the largest over-the-counter precious metals market in the world. When those holdings rise or fall, it does not automatically mean global supply has changed. It means metal is moving into or out of the London custodial system, changing where large bars can be mobilized for settlement, borrowing, leasing, or transfer into other forms such as exchange inventories or ETF custody. The silver story begins with an unusual episode that still shapes today's baseline. In early 2021, LBMA reporting showed large expansions in the silver stock held in London vaults, culminating in the record 38,859 tons at end March 2021. By end May 2021, LBMA reported 36,440 tons. These are not small differences. A shift of even a few thousand tons in a wholesale vaulting system changes how easily large positions can be created, rolled, financed, or delivered. But the most important feature of that 2021 peak is what happened afterward. By early 2025, the reported holdings were not merely lower, they were approaching the lowest observed level since the dataset's early period. Reuters reported that London silver holdings fell in February 2025 to 22,462 tons after an 8.6% drop in January and a further 4.5% drop in February, reaching the lowest level in the LBMA data series, going back to mid-2016. LBMA's own quarterly market reporting aligns with that direction of travel. In the LBMA Precious Metals Market Report for Q1 2025, the association stated that the weight of silver held in London vaults declined significantly during the quarter. It reported that at the beginning of 2025, there were 827,544,000 ounces in London vaults, and by end March, that figure had declined 14% to 711,396,000 ounces. Converting those ounces to metric tons using the standard factor implied by the LBMA's own notes, that change maps closely to the mid-20,000 ton range at the start of the year and the low 22,000 ton range by quarter end. The story told by the data is consistent. Silver was leaving the London vaulting system in size. At first glance, it is tempting to treat a vault decline as a simple shortage signal. The market reality is more mechanical. Wholesale bullion moves for reasons that are often unrelated to mine supply. The same bar can change jurisdiction without changing ownership, and it can move from one vaulting network to another because of settlement requirements, financing incentives, or future spot dislocations. That is why the gold story matters here, because it provides a documented example of how large-scale relocation can be driven by market structure rather than by a change in global metal availability. In early 2025, Reuters reported that significant quantities of gold moved from London to the United States as futures pricing and tariff-related uncertainty created incentives to shift metal to New York. Reuters described that since November, $64.5 billion worth of gold had moved to COMEX gold stocks in the U.S., pushing inventories up 126% to record levels, and that this movement thinned liquidity in London's OTC gold market, prompting market participants to borrow gold from central banks via the Bank of England's vaults. The same Reuters reporting noted that silver outflows from London to the U.S. also slowed in February but remained large enough that holdings reached that mid-2016 low. The critical point is not the politics of tariffs. The critical point is the transmission mechanism. Pricing differentials and settlement needs can reroute bullion between major hubs on a scale measured in tens of billions of dollars, even when global mine output has not changed. This is the framework for interpreting record inflows versus systemic outflows. The inflows are visible where inventories spike, such as exchange stocks in the United States. The outflows are visible where custody systems report declining totals, such as the LBMA Vault series. Both can be true at the same time because the global market is not a single pool. It is a network of pools connected by arbitrage, transport capacity, bar specifications, and financing. When a pool that supports the world's dominant OTC settlement system is drained, and another pool that supports futures, settlement, and collateralization grows rapidly, it signals that the market is prioritizing deliverability and margin mechanics in the destination venue. Now place those bullion flows inside the fiscal environment of the United States, because the phrase tied to ballooning U.S. national debt cannot be treated as a slogan. It needs explicit public numbers. In fiscal year 2024, Reuters reported the U.S. budget deficit at $1.833 trillion, with interest costs on the debt surpassing $1 trillion for the first time. For fiscal year 2025, a Treasury-based analysis summarized that interest payments on the national debt totaled $970 billion. By early January 2026, U.S. gross national debt was reported at $38.43 trillion, with debt held by the public at $30.81 trillion. These numbers do not prove that debt growth caused a London Vault drawdown. They do establish a measurable funding backdrop. The U.S. government is issuing and rolling large quantities of debt at higher interest costs than the previous decade. And the interest line item itself has become one of the largest recurring cash expenses in the federal budget. Why does that matter for bullion plumbing? Because large sovereign borrowing interacts with the financial system through collateral and funding markets. U.S. Treasury securities are the core collateral instrument of global dollar funding. When Treasury issuance expands and the Federal Reserve is running balance sheet runoff, the distribution and financing of that collateral becomes an operational variable for banks, dealers, and leveraged participants. The New York Fed's annual report on open market operations described that SOMA holdings of Treasuries and agency MBS decreased by nearly $700 billion during 2024, and that Treasury holdings declined from $4.79 trillion to $4.29 trillion during 2024. When the central bank's balance sheet is shrinking, the private sector must absorb a larger share of Treasury supply and finance it in repo and related markets. That is not a theory. It is accounting. Less central bank holding means more private balance sheet usage to intermediate the same securities. In that environment, bullion is not only a commodity, it is also a financial asset that can be mobilized for liquidity. Gold, and to a lesser extent, silver have roles in collateral frameworks, margining, and balance sheet optimization, especially in the institutional market where metal is held in professional custody and can be swapped, leased, or moved between clearing ecosystems. When funding costs rise, the economics of holding metal in one place versus another can change, because the value of immediate deliverability into a specific settlement system increases. This is where the comparison between London and New York becomes concrete. London is the primary OTC settlement hub for loco London metal. New York is the dominant venue for certain futures contracts, and the ecosystem of margining and delivery tied to those contracts. A market participant faced with a widening spread between U.S. futures prices and London spot prices, or faced with the need to meet delivery or margin obligations in the U.S. system, has incentives to position metal where it reduces basis risk and settlement risk. That can mean shipping metal, swapping metal, or drawing down a vault pool in one location while building inventory in another. The LBMA Vault series shows that these shifts can be large and fast. The 2021 record silver level and the 2025 low are separated by less than 4 years. In the same period, U.S. fiscal arithmetic shifted toward higher interest burden and continued high deficits. In 2024, the deficit was 6.4% of GDP, according to Reuters reporting, and interest costs passed the $1 trillion threshold on a gross basis. In 2025, reported interest payments were $970 billion. Debt held by the public reached about $30.3 trillion at the end of fiscal 2025 in a Treasury-based summary. These figures describe a government financing regime that demands ongoing large-scale treasury auctions, rollover, and cash management. When the sovereign borrower is that large, the rest of the financial system's balance sheets adapt around it. Dealer inventories, repo volumes, collateral reuse, hedging demand, and the pricing of funding relative to safe assets. This is the point where it becomes useful to separate inflows into two categories. The first is investment demand that shows up as purchases of ETFs or physical bars, which can pull metal into certain custody networks. The second is structural demand created by the hedging and funding ecosystem, which can pull metal into the venue where delivery and margin mechanics are most efficient. The Reuters description of gold moving from London to COMEX inventories is an example of the second category. Metal repositioned to meet futures-related obligations and exploit price differentials. When large repositioning episodes happen in gold, they frequently carry implications for silver because the same vault operators, logistics providers, and bank balance sheets serve both metals, even if the magnitudes differ. A separate LBMA detail matters here. The London Vault data includes both commercial vaults and, for gold, the Bank of England. Reuters reported that the outflow of gold to the US thinned liquidity in the London OTC market and prompted a race to borrow gold from central banks, storing bullion at the Bank of England. That is not a retail story, it is a wholesale liquidity story. It suggests that when London's commercial liquidity is reduced by large transfers, the system can temporarily rely on central bank-held gold being mobilized through borrowing and leasing channels. This is one reason why holdings and availability are not identical. Some gold can be present but not readily available for commercial settlement without borrowing arrangements. Some can be present in commercial vaults but earmarked. Some can be present as ETF inventory and not freely fungible without creation and redemption mechanics. The same logic applies to silver, but with different institutional participants and without the Bank of England as a silver custodian. The observed plunge in London silver holdings by early 2025 therefore carries two separate meanings that can coexist. The first is physical. There was less silver inside the London vaulting system to support local London settlement and immediate commercial mobilization. The second is structural. The market's demand for silver in other forms or locations was strong enough to pull metal out of that system. This is consistent with LBMA's own Q1-2025 statement about sustained declines in London Vault silver during the quarter. By late 2025, the LBMA's monthly reporting shows that London silver holdings had increased from the early 2025 lows. End November 2025 was reported at 27,187 tons, and in December 2025 at 27,818 tons. That rebound is itself informative because it demonstrates that vault holdings can recover when market incentives reverse. When the spread that motivates relocation narrows, when deliveries are satisfied, when financing conditions shift, or when metal returns from one system to another, the same series can show rising totals. This is why the phrase record inflows versus systemic outflows is best treated as an observation about the market's plumbing rather than a permanent trend line. Vault inventories are dynamic, and the direction can change when price relationships and settlement needs change. So where does the U.S. national debt enter the story in a way that is factual rather than rhetorical? The debt enters through the cost and availability of balance sheet capacity. When deficits remain large and interest payments rise, Treasury issuance remains heavy, and the financing of that issuance becomes a recurring activity for primary dealers and the broader financial system. The New York Fed's reporting on SOMA runoff provides a concrete piece of that environment. In 2024, the Federal Reserve's Treasury holdings fell by about $500 billion. In practical terms, that is a shift in who holds treasuries and who must finance them. When balance sheet becomes scarce or expensive, assets that can be mobilized across jurisdictions and used in settlement chains become more valuable in certain venues. Bullion, particularly gold, can be part of those chains. Silver's role is more industrial and more market-specific, but its vault movements still reflect where liquidity is being demanded and where settlement obligations are being concentrated. Another measurable link between fiscal pressure and bullion dynamics is the behavior of risk premiums. When the U.S. government's interest costs rise toward the trillion-dollar scale and gross debt approaches the high $30 trillion range, market attention increasingly focuses on auctions, term premia, and the financing of government liabilities. That focus often coexists with periods where commodities and precious metals experience high trading volumes and volatility because the same macro variables that move rates also move the opportunity cost of holding non-yielding assets and the hedging demand of financial institutions. The LBMA's own Q3 2024 market report listed average daily volumes in the silver market in hundreds of millions of ounces and highlighted the scale of weekly volume spikes. High volume does not equal shortage, but it does show that the market is using silver and gold actively as instruments in the broader macro cycle. The cleanest way to summarize the mechanism, without turning it into prediction, is to treat bullion flows as a map of where the financial system wants metal to be when constraints bind. When the U.S. fiscal position produces persistent large deficits and high interest expense, Treasury issuance remains large, and the system's demand for collateral and funding capacity rises. When futures spot spreads and settlement requirements create profit opportunities or risk pressures, metal moves to the venue where those requirements are easiest to satisfy. In early 2025, Reuters documented large gold transfers to the U.S. and described simultaneous pressure on London's OTC liquidity and the need to borrow gold from central bank vaults. In the same period, Reuters documented London silver holdings at the lowest level since mid-2016. In 2021, the same LBMA data showed silver at record levels in London vaults. The distance between those 2 points is the story. The bullion market is not static inventory. It is mobile stock that shifts with incentives created by funding costs, settlement architecture, and macro conditions. The U.S. debt numbers provide the macro context for why funding costs and collateral mechanics have become more dominant. In 2024, the deficit reached $1.833 trillion, and interest costs surpassed $1 trillion on a gross basis. In 2025, interest payments were reported at $970 billion. By early 2026, gross debt was reported at $38.43 trillion. These are not abstract figures. They are the scale of the sovereign balance sheet that sets the baseline for global dollar markets. When that baseline changes, markets that depend on dollar funding and collateral adapt, and the adaptation can show up in unexpected places, including where physical bullion is stored. A final point is often missed in popular discussions. A vault drawdown does not only change a number on a spreadsheet. It can change the cost of borrowing metal, the ease of settling large OTC trades, and the resilience of the delivery system during volatile periods. When inventories are high, the system can absorb relocation and still maintain liquidity. When inventories are low, the same relocation can create visible strain, such as the borrowing from central bank vaults described by Reuters in the gold market. The LBMA Vault series is therefore not a curiosity. It is a monthly snapshot of the market's settlement capacity in the world's main OTC hub. By the end of 2025, London silver holdings had recovered from the February low, showing that reversals are possible when incentives change. But the wider backdrop remained: heavy U.S. borrowing, high interest costs, and an ongoing need for the private sector to finance large quantities of government debt, while central bank holdings were shrinking through runoff. The bullion market's geography in that environment becomes less about tradition and more about where metal can most efficiently serve the needs of settlement, margin, and liquidity. The LBMA holdings plunge, the documented inflows into U.S. exchange stocks during key episodes, and the ballooning scale of U.S. sovereign debt all sit on the same map. The map of where liquidity is demanded when balance sheets are tight and when the cost of funding becomes a central variable.